Hello, welcome back to our FTP session. And this is the second time we are doing the live on FTP. And this is because we had a lot of questions, a lot of feedback coming from our first session on first course on FTP. It was 16 hours course. And I'm going to tell you a bit more and to continue speaking about FTP. But before I do this, I would love to introduce myself to people who doesn't know me. And I would like to tell you about what I'm doing, what is my job, and also why FTP. What is it all about and why I feel this is so important topic. Okay, so first of all, my name is Beata Lubinska. I'm working in a UK bank based in London. It is the fastest growing fintech in UK, so I'm very proud of this. I'm treasurer of this bank since almost 6 years, leading the treasury department and many topics related to treasury, such as interest rate risk in the banking book and the strategies, hedging strategies. Also funding strategy, the hedge accounting, and of course, funds transfer pricing. Because FTP is the hot topic at the moment. It is important because we don't talk anymore about the FTP as only the measurement, performance, or risk adjusted performance management tool, but we are also talking about the steering and shaping and enhancing the strategy of the bank through FTP. So it is getting extremely important, and I feel like there is a lot of focus from regulatory perspective, from regulator, from stakeholders on how it works and what is the best practice. So before I go into details of today's session, which is quite interesting, we will be covering advanced topic today. So it won't be only the introduction. If you are keen to see the introduction to the FTP session, I encourage you to look at the web stream which we did in September. This was the first session on LinkedIn dedicated to the profitability, enhancing profitability and risk management through funds transfer pricing. But today I have something a bit more interesting because we will go into details. And I'm going to show you two main topics which we do today. But before that, I have to tell you a bit about the FTP itself, because we need to do the introduction. What is it? What is funds transfer pricing? What is it all about? How does it work? Why is it so important? So FTP is not only one thing. I always try to explain it very clearly that it's not only one rate, or it's only one document, or it's only FTP curve. It is many combination of many things. And it is, for example, you can say some of policies, some of documentation, practice guides, because usually we have FTP policy and we have FTP practice guide, which defines each aspect of FTP framework. Also, we have the FTP curve, because FTP curve is the benchmark, is the main concept behind the framework. We have target operating model, so we need to govern the whole FTP process. And of course, there are these advanced methodologies, which I cover only high level two, that's not high level, but only two of them, so that we can, see that they go quite deeply in detail. But FTP covers not only the interest rate risk transfer price, or liquidity transfer price, or contingent liquidity transfer price. It also covers capital. And in the session, in FTP course, which we have online, scheduled for January next year, we will cover the capital transfer pricing in very detail. And the reason for this is because I think it is quite underestimated element of the FTP framework and FTP concept, and it's very important to price it correctly. So, as we said, it is the sum of policies and methodologies which the bank apply to charge or credit products for liquidity consumed or gathered, because of course liquidity can be consumed on the asset side and gather on the liability side during the normal banking activity, because of course banks are lending on and borrowing from the customers, from depositors, from investors. So this is this fundamental role, and there are many stakeholders, and we said already in the first session that there are three of them, which are the key in the FTP product, if the FTP transfer price and FTP framework. The first one is the business line, is the business unit on the asset side, because these guys will be lending loans and will need funding to lend the asset on the long-term basis usually. So they are lending to the customer for 2, 3, even more, 5, 10 years. And of course, this liquidity is consumed for a long time. As such, they will be charged for liquidity, because in FTP framework, there is no free meals. I usually used to say no free meals, in the sense that there is cost of everything, and liquidity, capital are very precious resources for the bank, and they need to be optimized, they need to be managed very wisely, and of course they are not given for free. So liquidity has its extreme value for the bank, and there are different types of liquidity. As you know, there is liquidity value of certain funding sources, which is less than if we compare with other funding sources. So why I'm saying this? Because I want to tell you that we have different liquidity values, and liquidity is therefore priced differently. So the stable long-term funding, which is consumed on the asset side, will be priced accordingly, in comparison to something which is only consumed for 2 months or 3 months. Then let's talk about the liability side. So we said that asset side is consuming, and they will be charged the FTP price, FTP rate for those funding, which is corresponding to the riskiness of financial risks of the certain, the tenor, the kind of funding, the if we need, any contingent liquidity for this, or any other aspects, if there are swaptions or basis risk or prepayment, this has to be all priced in. And the FTP is exactly reflecting the riskiness or the financial profile, financial risk profile, or asset or liabilities. So when it comes back to liability side, just the other way, they will be given the FTP, they will be recognized for liquidity value, because of course they are bringing in funds to the bank. So as such, they are recognized the liquidity value in line with the, for how long, what is the quality of the funding which they are bringing in. Is it LCR friendly? Is it survival horizon friendly? So all those considerations are priced in. But in the middle, there is another unit. So we used to speak about business units as you notice probably, we said business units. So asset side, liability side, these are business units, and they are producing the profitability for the bank. They are obviously the generator of profit for the bank. But there is also another unit in the middle, which is very important, which is named bank within a bank. And this is the center of the FTP framework and process. And treasury of the central unit. And in our course, I will be referring to the central unit as ILM or treasury interchangeably, not because I don't recognize that treasury and ILM could be. Is it okay? Oh, now can you see me too? Okay. So it's not because we think that ILM is always reporting to Treasury. It is because sometimes we know it's separate. So Treasury is not always equal ILM, and also ILM is sitting within Treasury, but Treasury has also some other responsibilities. So it's not only ILM. However, in our course, we're referring in October, when we had the 16 hours course, we were referring to the FTP applied on the central model, which is known in the FTP and the FTP language, the central maturity matched funds transfer pricing. And this is exactly what we discussed. So the central model, where the risk from the business unit on the asset side and liability side were transferred to the central unit to be managed centrally by ILM. And as such, there is also the profitability, which is generated by treasury. Treasury is managing risks. The risks, financial risks, which the bank or operational model of the bank is generating on the ongoing basis. So this is the task of Treasury Department. They are managing the exposure to the interest rate risk in the banking book, or the fact that banks are always running the rate mismatch. So we know that on the asset side, the repricing of the asset side is different in comparison to the repricing of the liability side. We are never matched funded, always never. This is because it would be not viable and it would be very expensive model for the bank. So as such, the banks are accepting fact that there are always risks implicit into the balance sheet structure. And Treasury will be managing this risk so that the business units can go and focus on the relationship with the customer, and the spread can be locked in. So this is very important introduction before I start jumping into these topics which I wanted to cover today. And the topics which I want to cover are first, how the split works between different components of the FTP rate, and introduce to you the proxy risk-free rate for the soft currencies. So to show you the example how we could potentially build the base rate curve in the geographical location where we don't have the liquid benchmark instruments to build this reference curve. So I will show you the methodology which is based on the cross-currency swap, and the second one, credit default swap. And then I wanted also to talk a bit about prepayment, and the rest will be saved for January because we have a lot to cover. But the course will be basically covering all aspects from the beginning, from the different methodologies, from the central model, how it works, why do we need to have the central model, what is the role of Treasury Department, what does it mean, ILM zero-sum game and bank within a bank, and the next, this advanced methodologies, how to create the curve. What if the bank is only funded through deposits? How to set up the FTP curve in such a situation? If we don't have access to the wholesale market deliberately, because maybe this is the choice of the executive of the bank, or maybe because there is no need to have this access at that particular time, and there are some banks which live well without access to the wholesale market, so only deposit market. So what about them? Or what will be, this particular model, the curve setting model, when we have the situation when we have too many behavioral liabilities, and by behavioral liabilities, I'm referring to all non-maturing deposit, so the deposits which goes through the behavioralization process, and we know that there are a lot of methodologies to come up with the correct behavioralization, so how to FTP them if you have this, modeling in place where you have the volatile portion, stable portion. So of course, FTP for this product, to come up with FTP for this product is not a trivial task. So this will be also, covered in our course in detail, because we will be calculating how this FTP, blended FTP, looks like based on different behavioral assumptions. And yes, that's the prepayment optionality, the additional add-ons or adds-on on the FTP curve is also something we'll be covering in detail. So what if Treasury has to enter into the swaption because they want to to hedge the pipeline risk, or the swaptions to hedge the prepayment risk? So who should pay for that? And finally, very important portion of the course is dedicated to the balance sheet shaping through FTP. I'm sure you heard many times recently, and let me just tell this and then we go into details about a balance sheet management, balance sheet optimization model. So balance sheet optimization is talking about, obviously, the optimal structure of the asset or liability, or asset and liability side. And as such, it means that there is a need to, based on the certain constraints, to come up with the ideal or target profile of the balance sheet. So once we have this balance sheet, so if we know that the target structure looks like X, Y, Z rather than A, B, C, how do I achieve that? How do I shape that? So how do I move from point A, from suboptimal structure, to point B, which is defined optimal structure? How do I change the balance sheet? And this is where the strategic funds transfer pricing comes into the picture. FTP will be helping us to incentivize the products which we want to grow on the balance sheet, and will be disincentivizing product which the bank wants to get rid of. And why the bank should get rid of these products? Because maybe they are not profitable, they don't bring the value to the balance sheet. That certain products can add value to the balance sheet, but certain can destroy the value of the balance sheet. And FTP, this is why it is so important, because if we apply FTP incorrectly, then we could destroy potentially the value of the balance sheet. This is why FTP is so powerful tool, strategic, which should be aligned with the objectives of the bank and the strategy of the bank. It must support the strategy of the bank, because the term strategy is exactly what is important in the FTP framework. So as I said, before we go into details, it is not only the profitability measurement tool, it is also the balance sheet shaping tool. Okay, before we go, let's have a slide. Ed, could you please show the slides? Thank you so much. And the slide number 1 is showing exactly, I will bring it full screen so we can see exactly what it is. I will be answering all the questions by the end of the session. So I see that you are now writing question, and I'm very happy about that. But please give me time to cover first the topic, the concept, and then we will focus on some questions, not all, but some questions definitely will have the Q&A. So thank you for this. Let me bring full screen and let's start. I did a quite long introduction, but I felt that this is important because we don't have in this slide what I usually start with is the central structure and the maturity matched funds transfer pricing model, the central model, and you don't see those stakeholders. So now I thought it's very important that we start, to introduce this FTP central concept and ILM within a bank within a bank, and ILM zero-sum game, which I will explain as well. Okay, so what we have here is the components of the FTP rate. We said that assets are charged FTP rate and liabilities are recognized FTP rate. But what is exactly FTP rate? So FTP rate is the combination of different building blocks. It's not only one rate which covers one thing. We already said so. We said that they are building blocks which are pricing in different types of risks. The risks are priced so that there is this risk-adjusted profitability measurement at the business unit level, and also because we need to know how much we have to transfer from the business unit to the ILM, to the central unit to be managed centrally. So the first building block, which you see this black one, on the at the bottom, is reference rate, which is corresponding to the interest rate component. So the fact that there is a common, like say, ground for all these instruments. So imagine the fixed rate asset, which is priced off what? 5 years fixed rate asset is priced off, if it's fixed rate, of the swap rate. And why is it priced of swap rate? Because this is the first component, this benchmark component, and the interest rate risk component, which Treasury will be hedging. Treasury will be pricing, and Treasury will be, or maybe not, will be hedging. But the decision at the central rate, at the central level, if Treasury will be hedging or not, is something different. We are not going to talk about now interest rate risk strategies and hedging, because as you know, it's not necessary that Treasury hedge everything. Treasury needs to manage the balance sheet proactively, but does not mean that everything is immunized completely at the central level. But let's continue. There is the second component. The second component is hugely important, is one which is bank specific, which means it does not, meanwhile, the first component will correspond to the basically geographical location. Because if you think about UK, we'll be talking about the interest rates level in UK. So this will be common for all banks in UK. They will have this for 5 year swap, they will have this component the same, because the swap rates are the same for the banks in UK. They are priced, and we know that they are, you can access them through Bloomberg or market data system, and you know what is the 5-year swap rate. But the second component is different. It is bank specific, which means that it corresponds to the riskiness or perceived riskiness of the bank itself. So imagine you have smaller bank and bigger banks, comparison of those two banks. And of course, the bigger bank, the international bank, maybe, with many, many years in the market, they've built a lot of customer base. They are trusted. They have the loyal client base, and, they can price, accordingly. So, which means that their term liquidity premium, and I'm introducing now the TLP, term liquidity premium component, will reflect the fact that they are, they're pricing products differently in comparison to the smaller bank, both two banks in headquarters in UK. Imagine they are in UK, and they have different TLP, because the bank, which is smaller, with lower customer base, or building the customer base, still in process of building customer base, they will be perceived by the customer a bit more risky. So they will be the requirement for the higher TLP to reflect that. So basically the TLP or market, if you think about the capital market, this is the best, definition of the TLP, because if you are issuing the senior debt and you are pricing it in the market, so the quotes which market or the risk premium for this liquidity is different for one entity and another. And this TLP is very bank specific task, how to determine it, how to build this additional, spread on the top of the reference rate or benchmark rate. But we said, okay, those two building blocks are the most important, which we see commonly in FTP framework. But there is obviously another component which is very important as well. Meanwhile, TLP corresponds to the deterministic cash flows. And let me explain it. So when you talk about the asset, and we want to calculate the TLP for this particular asset, we will be looking at the contractual cash flows which this particular asset will be, will be paying over its life. This is contractual schedule of the product. It will be maybe amortizing over time, or maybe it's bullet product. However, we need to know this structure. And there is also something which is known stochastic cash flow. So, for example, if you think about liabilities and instant access product, those products, as the name indicates, they don't have any contractual maturity, any deterministic maturity. We call it in ILM jargon liabilities without deterministic maturity, which means that we don't know, there is no certainty about when this liability will be withdrawn. As such, there is a need to hold a buffer, the liquidity buffer, which obviously in the Basel III world is on the LCR, on the survival horizon, and we know that each bank has to quantify and to hold the sufficient amount of high quality liquid asset, which could be cash, which could be the bonds, high quality bonds, which needs to be, ready just in case. So you can deploy them immediately if you need cash. And because you have to support the withdrawal on the liability side. So this is additional component in the FTP which has to be priced. So it's not only the deterministic maturity and the FTP which is built, which is calculated, I should say, not built, calculated based on the deterministic maturity, but there is also the aspect of the buffer, HQLA. So we have to hold additional amount of cash, amount of liquidity, and this has to be priced as well. Because as you know, if you're a treasury practitioner, you know that usually the maintenance of high quality liquid asset, HQLA, is not for free. And usually when the rates are a bit lower or normalized or lower at the lower level, like it was during COVID times or during the low rate environment time, then this buffer is extremely is driving basically the loss. It is P&L drag. And this is known as negative cost of carry because the funding of this buffer is more expensive than yield which is generated by the bond. And given that we have this difference negative, we are talking about negative cost of carry. So we have to answer the question, who will pay for this? It is not Treasury's holding is managing liquid asset buffer, is quantifying liquid asset buffer, is stressing, is reviewing the size of liquid asset buffer. But Treasury is holding the liquid asset buffer because they are products on the balance sheet, which gives rise to this call cost, contingent liquidity cost. I will call it call cost of liquidity. So as such, it has to be charged out the central unit on the certain product which are driver of call. And this is the number 3 component. This is what we call here indirect liquidity cost. So if you look at this FTP is at least covering those 3 components. Now, those 2 are always part of the FTP rate, the reference rate and TLP. Call, it depends. Sometimes it is charged on the separate basis. Sometimes if you do the behavioralization, which reflects the LCR requirements, sometimes also you see the NSFR included in the behavioralization of the product, then it is already included in the whole FTP rate for the product. But there are different methods of charging out call from the central unit to business units. So you have to quantify it and you have to charge it out. So it cannot stay at the central unit piling up the losses, which, because otherwise, if you don't charge it out, if you don't charge correctly the cost of liquidity, what we will be doing, we will be subsidizing the assets, or, potentially we won't penalize the liabilities for the fact that they are raising this necessity of call as well. So it has to be recognized. And all-in rate is the rate which is a composition of FTP and other elements. What are these other elements is, again, another chapter in FTP. It's also part of the FTP, sessions, because it's very important how we determine return on equity for each asset, how we calculate, what is the role of the FTP in this process. This is another story. This is another, thing which we need to be able to determine. However, just high level at the moment, I will tell you that this all-in rate, which we said is the composition of the FTP and other elements, these are credit risk considerations. At the moment, we don't include credit risk in the FTP. It is outside FTP rate. Then we have some product costs, because product, if we originate product, is not for free. We have to cover costs of the production, origination, marketing of this product. So it has to be included in all-in price. And then we want to generate some margin, which each product will be providing us with, and will be different by each product. So if you look at the all-in rate, if I have two different products which are generating the same all-in rate, but they have different net margin, different FTP, different credit risk consumption, of course they are not the same. Even if they are producing the same all-in rate, the profitability of this product will be different. And this is why we have one of the reasons of having FTP in place. Very quick, calculations, because as we said, we will be going a bit in detail today. So imagine you have 5-year loan at 2.9%. This is the customer rate. And imagine that FTP rate for this product is for 5-year FTP for 5 years, for fixed rate product is 2.3. So if we think about the margin of this product, or commercial margin, and commercial margin does not equal to the profitability of the asset. As we have seen in the previous slide, there are many aspects of this profitability. So you have to take it into account. But this is net of FTP, how much this asset is generating. And this is known as lending margin or commercial margin. And this will be difference between 2.9 and 2.3. So 60 basis points, which is purely generated by the lending product net of interest and liquidity risk costs. Now let's see at the liability. Liability is here at the left-hand side. You see that we are talking about 6-month deposit. And we have deposit at 30 basis points. So we are paying to depositor 30 basis points. We are paying for the deposit, for the fact that they are willing to place the deposit with us. So the remuneration to the customer is 30 basis points. It is 6-month deposit. So, of course, we need to know what is the 6-month FTP to be able to calculate the margin for this particular product, for this liability. We said that asset and liability and the central unit are providing profitability for the bank and enhancing the profitability for the bank. So in this particular case, you have 6-month FTP at 90 basis points. So the liability side is getting 90 basis points in the form of FTP, 6-month FTP rate, and is paying to the customer 30 basis points. So there is the difference between 90 and 30. So again, we have 60 basis points, also profit for liability side. So 60-60. 60 for asset, 60 for liability. But then you will ask me, but what is going on in the middle? In the middle, we have 90 basis points, 6-month FTP, which Treasury is paying to the liability side. So we are paying to this business unit 90 basis point. We are receiving from the asset side 2.3 in terms of the 5-year FTP. So, there is the difference between 2.3 and 90 because the FTP for long 5 years is higher. On the assumption of the upward slope of the curve, we assume that it's higher than the 6-month FTP. But within this, I still want to know what is the portion which is of this treasury profit. And let's not think about can treasury has profit, or can treasury generate profit, or maybe not. Maybe they should be only the service center. It doesn't matter in this particular example, because if we don't have treasury as the service center, this profit will be recycled to the business unit to support the strategic initiatives of the bank. So in this particular case, we will split this internal unit profit in two parts. So how much of this profit is driven by liquidity management? So margin generated by liquidity risk, maturity transformation. So the fact that all banks run maturity transformation, as we know. So we are funding the long-term asset with long-term maturity by shorter-term liabilities. This is key concept of banking. It is known as maturity transformation. And a big chunk of profit of banks is driven by this, by the fact that they assume that liability which have the shorter maturity tenor will be rolling over, and we will manage to roll them over. Fantastic. Let's talk about the first component, which is interest rate risk. So again, we have the assumption that the curve is upward slope. Therefore, the 5-year swap rate is higher. This is what's our assumption here in this example, is higher than 6-month swap rate. So if so, we will get the positive contribution from the rate mismatch. So the fact that long-term asset has the 5-year swap, is priced on the 5-year swap, which is higher than the 6-month FTD or deposit. And you see clearly, so with FTP, you will get this clear visibility what each business unit is generating, and even more at the treasury level, you will see what is driving this profit. Of course, in order to see it, this holistic picture, you need to get, I call it, glasses. So ILM system, which shows you how to manage it without, which shows you what's going on. Otherwise, how do you see the 10 billion of risk-sensitive asset funded by, 9.5 billion of risk-sensitive liabilities? How you are not able to see this detail in Excel spreadsheet. So of course, in order to have this clarity, the vision, the deep dive into the FTP, you need good ILM system. And then you will be able to see also this contribution to each portion, so to the liquidity portion, interest rate risk portion, and what treasury is, how treasury is contributing to the whole profitability picture. Okay, you may ask me, what about the floating rate asset? So, it's easy. when we talk about the fixed rate asset. But what about the floating rate asset? Is there any difference? Of course there is. So the reason is because we are still applying for the floating rate assets, so shorter repricing asset. Imagine that we have asset which reprice every 6 months, 6-month refixing, so based on the 6-month refixing, but 5 years maturity, we still need to reflect the fact that this asset is consuming liquidity for longer. And this is important because otherwise you will be only allocating, the shorter FTP rate. Meanwhile, it's not correct because you are not transferring the whole spectrum of risks which are embedded in this product. So this is why you are still recognizing, you are still charging to the asset side the long-term TLP. Even if the ITP is shorter, the TLP is long-term TLP, which you need to price in. So this has to be clear. And as I mentioned before, we have different components. So when we price, and this is exactly what I wanted to show you today, very quickly, let's go through those two components. So we have the interest rate component, which is ITP, which could involve additional components. As we said, we have the basis risk adjustment, the potential automatic option adjustment, the prepayment risk adjustment, how to price it, how to deal with this, how to quantify it. And this is also the part of the FTP methodology, which needs to be very clearly defined in the practice guide. And of course, you have all, LTP methods if you want to price in other components. For example, not only the HQLA, but sometimes you have the mandatory reserve. How do you price all those components there? How do you define this TLP? Is it blended TLP, which is dependent on how do you price, how do you fund your balance sheet, and if it's a mixture of deposit, of wholesale funding, how you determine this. This is again the topic which is very important, and I hope we covered it last time quite in detail and we calculated it. These are the components, and I wanted to show you because I know that the time is running quite fast, and unfortunately FTP is so emotional topic, and for me it's an ocean. So I could stay here the whole night talking about FTP, but I know that we don't have this time. So let's go through the example of a bit more complex methodologies, which could be helpful, and I hope they will help some people who are dealing with the soft currencies. So the currencies which don't have necessarily the liquid swap market. So how to define this risk-free curve, this benchmark curve, which was the first element, the first building block in our FTP rate, in our FTP curve. How to draft it, how to design it if I don't have anything in the market. Quotes, I don't have swap quotes. How do I, draw the line? So there are few methods. I'm going to show you two. The first one today now. The first one is based on the cross-currency swap. And you can still obtain the swap rate or the proxy swap rate in the local currency based on the cross-currency quotes in, for example, USD. So you will find the quotes in the correlated currencies, for example, if you talk about the Qatar currency, you will definitely look at the USD currency to get, cross-currency swap and the basis. And you will adjust it and you will create it through the basis. So how this work? That cross-currency swap are common instrument to manage and fund the balance sheet. If we are talking about the different currencies between asset and liabilities, and you need funding in another currency. So imagine we have the bank BL, which has raised a 2-year fixed rate deposit in GBP. In this case, we have the UK currency, 50 million at 30 basis point with interest payable every 6 months. At the same time, it is providing lending to the customer in USD. So you see that there is this currency mismatching between asset and liability. And this is priced at so far plus 2%. So how we deal with this mismatching? So in order to hedge the currency risk on the loan and deposit transaction, we will enter into a 2-year cross-currency swap where we receive the fixed rate sterling at, this is example, the rates are example, 20 basis points, and we will be paying SOFR flat on the US dollar leg. Because of course, you think about this, you want to receive sterling because you are paying depositors in sterling, and you want to fund in GBP in USD because you are lending out in GBP in USD. Sorry, in USD. So assuming that we have the SOFR rates for the life of the swap equal to 80 basis points. Of course, we know that it's not the case, but let's imagine in this example, I didn't want to change. And we have the exchange rate of 1.3 sterling USD. We can obviously locked in this rate. We have this rate locked in. We are exchanging principal because cross-currency swap, you know that we are exchanging principal, not like in interest rate swaps where we don't. So this is the structure of this transaction. So the bank BL borrows 50 million at 30 basis point fix, lends 65 million at SOFR plus 2%. This is what we said. So the structure looks like this. These are the flows which you see. So we have the outflow on deposit, 30 basis point to investors. You have the cross-currency swap. You have the GBP leg. When you receive GBP and the cross-currency swap, of course, and you obviously receiving 20 basis point on the swap, like it is here, written here, then we have the USD leg, which is so far flat, and we have from the loan on the asset side, the SOFR plus 2%. So this is how it works. So in order to show you the example, I just wanted to show you how it works. So in this particular situation, GBP side, we are paying 30 on deposit, and we receive 20 basis point from the swap. So you see that there is this leg, this side is, we receive less than we pay. On the USD side, the bank BL receives SOFR plus 2% from the loan and pays SOFR flat and the swap. So this side is profitable, yeah? So what determines, first question, what determines the fact that on GBP we receive lower rate and we pay higher on USD? Of course, the first pricing component is interest rate level differences. So differential of interest rate on currencies involved, on GBP and USD. The second one is the basis. So the fact that there is demand and supply in the market for funding in one currency versus another. So it's not, it's not only driven by the purely mathematical calculation, but there is also the fact that there is, if there is high demand for USD funding, the US dollar leg of the swap will include the premium, the basis premium, which could be, or we pay a little more USD interest, or you will receive a little less on GBP side. So this is how it will be adjusted, the basis of the cross-currency swap. And of course, we need to think about the direction, which direction the bank is swapping. So in our example, the bank borrows GBP and it pays USD and receives GBP on the swap because it enters then cross-currency swap. So how we can transform it, all this stuff, why does it matter? Because we want to create the proxy risk-free swap curve in another currency, which soft currency, I have this here, Brazilian real, where you have, for certain maturity, using the cross-currency swap. So we don't have the, let's say, 5-year maturity on the interest rate swap in Brazilian real, sorry. But we do have the interest rate swap in USD. So we could then adjust with the cross-currency USD versus Brazilian real basis for that particular tenor. We said it will be, for example, 5-year maturity. And let's imagine that the 5-year swap USD is 3.5%. We have the basis, cross-currency basis of 1.6. Then you could assume that the proxy for 5-year swap or proxy swap or the risk-free curve could be synthetically constructed based on those two components. So this is one method. And of course, I know that I have to rush. We don't have too much time to go through all of this example, but this is how it looks like here. So basically, we are saying that it is corresponding to two alternatives which the bank has. Number one, borrow in USD at SOFR. In our example, it was, do you remember, 3.5%. Then swap it in Brazilian real, pay SOFR plus 1.6. This was this cross-currency swap basis. So we will have overall 5.1. Or you can say, let's borrow directly in Brazilian real at the local risk-free, which will be 5.1. So you have two choices to achieve the same thing. So you see that these are, quite handy methods. Of course, there is another one, which is my material will be shared with you so you can have a look. I will cover, obviously, this with during the course, and we will go through more methods and through calculations. I know that maybe I took too long to go, through details of this, and now we don't have time to look at the CDS construct of the proxy risk-free curve, but you will find it in the deck. It is all in the deck. Just let me tell you something about the prepayment, because it is very important. So in FTP, prepayments are very important. Usually, when you calculate you have two types of prepayment. One is statistical, or based on the historical data which you see. So it is not rate driven. It is driven by the situation of the individuals or portfolio of people, because they are maybe, something changed, they moved their geographical location, situation changed, and they are repaying earlier. So of course you have this cash flows which needs to be always adjusted by the prepayment rate. But then you have also the financial prepayment. A financial prepayment are very rate dependent. As you know, when the rates are moving up, there is less likelihood of repayment of the loans or early redemption of the loans. And the other way around, when the rates are moving down, we see the increase in prepayments. And this is known as this phenomena of conditional cash flows, because they are conditional on the rate. So Treasury is hedging it. And as you know, the prepayment, you are modeling them, and you will execute a portion, will be hedged, definitely. As I said, it's not about the hedging strategies, but I want still to show you that the swaption, which is receiver swaption, on the swap, with a hedging tool for prepayment, for this financial prepayment. So you will need to include the premium which Treasury is paying to the counterparty of the swaption. It is OTC instrument. So obviously you have to pay the premium. And the premium is also because this is like insurance scheme. So you are paying for the fact that when the rates are at certain level, this option, which is swaption, is executed. And then, the buyer and seller of the swaption are acting accordingly based on this contract, swaption contract. So the cost, given that the swaptions are expensive instruments and the price of them is very much driven by the volatility in the market. So you can see if there is high volatility, then you see this price for the swaption is at the sky level. So someone has to pay for this. So if I have asset which is exposing myself to the prepayment, I need to charge it out. I need to charge the cost of this optionality on the asset side, and there is some percentage of customer which you think will repay earlier. Again, it's not, because in order to calculate it, there are ways of calculation of this adjustment. And it's not the full price, of the swaption, which is always charged to 100% of assets. It's not like that. But unfortunately, we won't cover it now here, this thing, although you can see it in the deck. Let me also mention event which we will be having on 4th of February. The event will be Treasury event, the future of bank treasury. We will be discussing what is future of this very important department for the bank. What is the role of artificial intelligence there? could we have something like mini treasure, and how we can leverage the deep learning tools and in general machine learning, which is already leveraged, as you know, for the NMD's modeling. But is it possible to optimize the balance sheet and funding structure through the deep learning tool? So this is all we will be, it's a lot of course, about FTP, about the future, about the strategies for managing profitable, proactive treasury department. We will be discussing in the event. Okay, let me have a look at some questions. Unfortunately, not all will be able to cover, but I'm picking up some of this. We have one. How do you obtain the liquidity transfer price component? What sort of model is common to see here? Apologies. Absolutely good question. I expected that question. 3 methods. You have one method based on access to the capital market. So you will be driving the price of the TLP by each tenor based on the cost of the senior debt issuance or capital instrument in the market. And this will be basically the difference between the swap curve and the pricing of this. This will be your TLP for each tenor. However, if you want to allocate to TLP the full, cost of those instruments, which are quite expensive. Capital market is expensive. And it means that you will be using this LTP to recognize the liquidity value on the liability side, which means you will be giving them high FTP rate, which means that they will be getting good rate, FTP rate, and will be driving high profitable department. So you will expect the growth of those behavioral liabilities, so deposits and other product, FTDs, for example, or notice accounts, because they will be remunerated good FTP. So this method was very commonly used when you had the asset momentum, you had very strong growth of the balance sheet, because as you know, the TLP answers the question, what is the marginal cost of raising additional, funds to fund 1 unit of new asset? So this marginal, not historical, marginal additional cost, how much it will cost me to found this additional 1 unit on asset side. And this is what the concept behind FTP is, always marginality. It is very important, marginality, not historical cost. So this means that you will be driving the growth through this first method of allocation TLP very aggressively on the deposit side, because they will be getting better TLP. So you have to be careful if this is what you want. So when you grew balance sheet in the previous times before financial crisis, then it was also cheap, relatively cheap capital market access that the banks were doing it. This method was very common. Now, when we have the majority of deposits, the methodology has changed. So you need to think about it, how you fund your balance sheet. And this is what funding optimization comes into the picture, because you need to answer the question, how I will fund the balance sheet over the next 3 years, 4 years, 5 years, 6 months. And based on this weights of the different funding components, you will be allocating the blended TLP, which will be composition of the funding structure, weights by each tenor, and this is known what is the blended TLP based on deposit market access. So they are different, at least those two models, and there is another one which is growing recently in Europe in importance, is the access reliance on behavioralization in the TLP construct. So you need first to build this attrition model for NMDs, and then you will allocate the different by each tenor, how much you can rely on your NMDs for each tenor. So you expect that by the short tenors, your reliance is higher, it's very high than if it's longer term. So you will get, for 1 month, I can assume that my asset will be funded by 99% of NMDs, and 1% will be other sources of funding, which could be FTDs. So it will be blended, TLP from one and second product, so funding source. When you go further, the curve, 5 years, you cannot anymore assume that 90%, 99%, you can rely still 99% on your NMDs, because you expect some attrition model, some attrition curve. So therefore, you will assume that maybe, 60% is funded by other funding sources. So you will introduce this blended rate. Okay, this is one. Second one, to what degree tend retail customers to execute on the option they are given? Does this efficiency of the customer affect how much swaption should be used in the pricing? Retail customer to execute depends, obviously, on the asset characteristics. So if you have any early repayment charges or penalties which are included in the products, of course, we won't be then passing on the customer the swaption price, because there are some protections in place for the bank. But if you have the model, the asset, which are, they can prepay whenever they want, there is no, in the contract, there is no penalties for them, then of course this is higher risk for treasury, so it has to be priced in. And you will need to, of course, it's not 100%, because treasury will be calculating this option adjustment according to some probability model of occurrence of certain scenario. So we are running a lot of scenario, interest rate scenario, and based on the probability of execution of this scenario and execution of the swaption in each scenario, you are calculating this option adjustment spread. So it depends on what is the characteristic of the contractual aspect of the product. What FTP strategy would you recommend for the case of the inverted yield curve? Look, I know that this was the case in UK. We had the case as well of, obviously, in our bank, in FTP. Depends again. If you want to make, as you know, FTP there is no one size fits all. So you have something which is known management overlayers in FTP. Depends on your strategy, on your objectives. For example, in some banks, you mainly have products which are 5 years or 4 years or 3 years products. You don't have 2 many products which are, 1 month or 3 months, or, you have very concentrated, the offering on the asset side. And this is because this is what is selling well in the situation when you have, high rates, the rates moving up, I should say. So then you have a lot of customer which wants to fix the rate now, so they are going for fixed long-term asset. The other way around, those assets will switch, the customer will switch from the fixed rate to floaters when you have the normalizing, or going down scenario. So it depends what kind of product you have on your balance sheet, the first number one, which product you want to, to go with, to incentivize. And if you need to apply some management overlayer to reflect the fact that, and usually TLP should be adjusting slightly this difference between, which is driven by the humped curve, inverted curve. Yeah, so still, if you are looking at the long-term asset, you have the TLP, which will differentiate and will adjust the FTP for those products. But yeah, of course, we had the same product. Yeah, what does it mean that, we are charging more the short-term assets than long-term assets? How does it work? And of course, it's the fact that, the curve was inverted, and it was not the normal upward slope of the curve, which we discussed in this podcast, in this session. Let's have another one. In the FTP, should funding cost influence it, or is it better to split it so that funding have a separate FTP, such as NMD, allowing to visualize its value better? So in this case, the branch that takes on the NMDs, or the market unit that fixes the funding, would deposit it at the treasury and be paid FTP. Yeah, okay. So very interesting question. NMDs are cheaper funding sources. So again, what is your FTP objective? Is it mainly to focus on the asset side and make the value, you pass the benefit of the cheaper funding cost to the asset side, which means that you will be, obviously, the asset will be benefiting from the fact that you have access to the cheaper funding source, which are those NMDs? Or is it basically some kind of recognition to the liability side, the fact that, they are bringing good value funding to the bank, and they will get the FTP? Usually, my advice is to have one FTP rate for one FTP curve in one geographical location for asset and liabilities. And this is why it has to be corrected. It has to include also the fact, like I was mentioning, this behavioral attrition model. So your benefit of your NMDs should go in the TLP. This is my personal view, especially because in UK or in Europe, we have so much funding coming from NMDs. So of course we want to include the benefit of this funding to increase the value of the balance sheet. It's not only about profitability of different business units itself. It's also about the value of the balance sheet. So in my view, there should be one FTP curve with the TLP, which reflect the composition of the funding structure of the bank. I think I went over time, and I do apologize for this because I know that I was not expecting to run it for 1 hour and a half. But again, FTP is so emotional topic, and it's so important in my view. So yeah, thank you so much for your attention, and I hope you enjoy the session. Thank you so much, Ed, for supporting this session, and I wish you all a lovely evening, and I would love to have you all in my session in January so we can discuss all these aspects in deserved level of detail because it's so important. Thank you so much.